if the pen.
All right, looks like folks are signing in here. Thank you so much for joining us today. We have two of our best on the show for you. So hope you're excited. Unfortunately, Mr. Tom Berkler, our usual MC, is not in the office today. So we are going to just all co-host together. If you have any questions for our panelists, you can enter them into the Q&A or the chat panels, and we'll read those out for you. Or if you like, use the raise your hand tool, and I will modify your controls so you can unmute your line and ask it live. And to get us started, we are going to go forward with Mr. Tom Nichols, our Disability Sales and Marketing Manager. Tom, take it away.
Well, welcome everybody. Real glad to be here. I have some interesting things I want to share with you today, and so does Matt. I think that the ideas that we're going to bring to the table will help with your business and help identify opportunities that you may not always know were there. But I think that what I'm going to bring is kind of the old cliche is you don't know what you don't know. And that many times that people have benefits through their work. They know they have benefits, but they don't really know what the benefits do for them. And so I have a producer out in the lovely state of Virginia that writes a lot of little disability policies, lots of little ones. And I got to talking to him about it. I go, what are you doing? And he says, you know, Tom, I work in the federal employee market. And there's a huge untapped opportunity here because most people go to sell disability insurance and they're going to go to the doctors and the attorneys and they're going to go to all the high net worth clients, but there's nobody talking to the federal employees. And I got talking to him. I go, wow, well, let's find out more about this. In fact, I even have a friend who is a federal employee that I got talking to about her disability benefits. And her first response was, oh, I'm a federal employee. I've got great benefits. Government employees have great benefits. I go, well, let's talk about it. So what we did was dove into her disability benefits. Now, what I want to do is a screen share here real quick so that we can kind of get a visual of what federal employees get when they apply for or get their benefits. Now, first of all, they've got a system called Federal Employees Retirement System, FERS. And this is their retirement, but it also gives them benefits if they were to get sick or hurt, and there's life insurance benefits. It's all built into their retirement plan. So if one of these federal employees were to get hurt or sick and couldn't work, it's going to pay them 60% of their earnings, which is pretty typical with a group LTD policy. But the good news is it starts only after 7-day waiting period. So they've kind of tied their short-term and long-term into one plan. They're making a distribution from their retirement plan. So now let's talk about what else it does. Well, they first make you apply for Social Security disability immediately. So because if you qualify for Social Security disability, what that means is your illness or injury is deemed to last at least a year or end in death. And then you would qualify for Social Security disability benefits because your FERS distribution is integrated with your Social Security disability dollar for dollar. So whatever you get from Social Security disability, your benefit would be reduced from your FERS program. And so your benefit would remain the same, but less would be coming from your FERS. The benefits are taxable to you. So if I'm getting 60% after tax, I might be only getting 47%, depending on your federal and state tax brackets. But here's the real kicker that most people don't know. Remember, you don't know what you don't know. Beginning year 2, the benefits through a FERS drops to 40%. Now, after taxes, we could be talking 27% of your gross earnings because you got federal benefits. So that's the thing that most people don't realize. Also, they're only going to pay benefits through this FERS program to age 62, because once you turn age 62, you're now eligible for retirement benefits through Social Security and FERS. So you're no longer on disability, but you're collecting your Social Security and FERS retirement plan. So that most people don't realize. So what do we do as advisors is we're able to go in, offer a supplemental policy. Now, most of these policies, again, are smaller because we're just picking up the difference. But because the benefits are lower, there's no exam, no blood, no urine, don't need tax returns. All you have to do is complete a telephone interview to answer the medical questions, submit an application. And if the answers to the health questions are good, your policy is issued within 48 hours. Now, the average premium on these cases is just a little over $1,200, $1,300, about $100 a month. That's the average premium for that supplemental policy. So again, it's real easy to get that policy, but more importantly, the supplemental policy pays all the way to age 67, which is your normal full Social Security retirement age, and the benefits are income tax free. So now we got a tax-free benefit that's going to pay us all the way to age 67 and going to make us whole. So that way we're not going to be destitute because I was a federal employee and I got sick or hurt and couldn't make my monthly bills because I only got 40% taxable from the government. So where's the opportunity? Let's look at postal workers, VA hospital employees, administrators. My friend worked for the Department of Labor. She was an auditor for retirement plans. She would go into corporations and audit their pension plans to make sure that they were compliant with the federal guidelines. But you've also got military physicians, dentists, even active duty. Mass Mutual has a plan that we can get active duty physicians and dentists, U.S. attorneys, federal courts, Environmental Protection Agency, Department of Transportation. All of these people have the same disability benefits. So they all need a little supplemental policy. And I think that once they know what their plan is going to pay them, I think they become cognizant, hey, maybe I should, take a look at getting a little policy to sit on top of it. There's a email address, bestplacesToWork.org. And you can go there and it gives you all the different federal agencies. And again, all of these people have the same benefits. 60% for the first year, drops to 40% beginning year 2, and they only pay to age 62. So that's where the opportunity is, and that's why we're getting lots of little policies. And again, you can do these applications right online, which makes it real easy through DocuSign as well. But we're here to help you put the case design together. Me, my trusted associate, Steve Jones, we know all the ins and outs and ways to put your client in the most favorable position. Now, even if you don't want to drive the bus, say, look, I've got an opportunity with these clients, but I do life insurance, I do long-term care, that's okay. If you make a handoff to CPS, we'll take it all the way to the finish line. You'll still get paid. And so we'll partner with you and make sure that your clients are protected and you end up looking like a hero. So with that being said, if there are any questions, feel free to put it in the chat box and we'll pick it up at the end. But I'm going to hand it over to my life insurance specialist, Mr. Matthew Gandy, and he's going to share some insights on where they're seeing success on the life insurance side. How about that, Matt?
Thanks, Tom. And yeah, nice little niche that you found here with regards to DI. That's definitely new information to me. So definitely something to look into.
Let me take that off there. There we go.
Yeah, sounds good.
Yeah.
And so along those same lines, Tom, talking about the federal employees, it reminded me of a case that we actually just got in and just got approved here at CPS with one of our partners, and it had to do with a pension, which is something that you would typically see on one of these federal employees. So we'll try to piggyback off our DI success here and show you what that might look like. And so again, should be shared. Now we get clients, and this is an older strategy, and pensions are getting rarer and rarer. But when you do see them, there can be an opportunity for the right client. So what I'm going to take us through here is a presentation that we actually ran, and to allude again to Tom, here at CPS, we're more than happy if something gets a little complicated out of your bailiwick, or you just don't have the time to speak with your clients about something, we're happy to go and do it. So this is a presentation that I prepared to actually present to that client. If you have a similar situation, we would be happy to take a look and see if this is something we could do for you. But this is what we would call a pension maximizer. And pensions normally come with a few options, and most typically you're going to see at least two. And these are going to be, for the purposes of this presentation, option 1 and option 2. And that is an ability to take your pension with a survivor benefit or with no survivor benefit, assuming that it's a married couple. So what this means, if I take no survivor benefit, myself as the person with the pension, in this case, I would receive $31,000 on an annual basis. But if I want to make sure that my wife continues to receive that income if I predecease her, then I would have to take a lesser amount of $28,000. But after I pass away, she would continue to receive 14. In some plans, this isn't all of them, and this can work differently. There may be an option for a lump sum as well, which is actually how this got brought to us. So this got brought to us by a financial advisor, where initially the thought was going to be trying to roll over that lump sum. Long story short, that lump sum would have been rolled over to an individual retirement account that the wife was going to have to sign off on. It was a community property, or it was not a community property estate. She had some concerns about that, so the lump sum was off the table. So let me look at the next slide here. So what's the problem? Here's the problem with your pension and choosing this joint survivor benefit, which seems like the best option up front. Because it's going to pay for both of your lives. The problem is, if my wife predeceases me, now I have to take this reduced amount for the rest of my life, and I've given up all of this income that I would be paying. To use the worst case example, I signed the joint survivor pension, wife dies immediately, I'm now stuck with the lower pension amount and no way to increase it. So what we can look at doing is purchasing some life insurance and opting for option 1, which gives us a higher amount. And we can use that higher amount to purchase some insurance to protect the wife in the event that I predecease her. And we'll get into some numbers. On the surface, it makes sense, but where this can fall apart as a presentation is showing the numbers. And that's one thing we are able to do here at CPS. So I'm going to go through this, if I can make it bigger for everyone, and briefly show you the type of analysis that we're able to do on something like this. We're going to make some assumptions. First, we knew this insured 64. We'd written him some term insurance in the past. We know he's a preferred. Nothing's changed there. I've input all of the information that we just went over with regards to their pensions options. We're going to assume that anytime that there's a windfall of money that someone's receiving, we're going to assume that they're investing that with their investment advisor, or in this case, when we were presenting with that investment advisor, and we felt like a fair rate of growth for the model was 6%. The pensions are taxable, so we're going to assume a tax bracket at 35%. And to give you some more color for this client's worth actually about $3 million. This is a small pension, not a huge part of his plan, which will be key. So first, we're going to look at this joint and survivor, because this is really our base case with regards to looking at our options. If we can't improve on the joint and survivor, realistically, we're not going to do it. So here's how it goes. Annual pension, as I said before, joint and survivor, $28,000. That's taxable, so we got to reduce it by our tax rate. And we'll go and we're going to say that we're at age 79 or year 15, the male is going to pass away. We base the life expectancies off CSO tables. You can see male passes away, the joint and survivor portion kicks in. You'll see the gross pension drops from 28,000 to 14,000, leaving us with $9,000 of income per year. And by the time the female, the wife in this case, reaches her life expectancy about 86, she's pulled out under this scenario about $339,000 of economic benefit. We're going to skip the lump sum for now because the wife didn't say to do it, but we're able to do this. Long story short, we're able to pull out just a shade under 400,000 in economic benefit. Let's skip ahead to what I call the insured pension. What we're going to do here is, rather than taking the lower amount of a pension to get the secondary payout or the survivor payout, we're going to take the higher amount and use some of the increase. You can see it's a gross of $3,180 per year. We're going to take some of that increase and put it towards insurance. So we did some magic math calculations and calculated that we needed $156,000 of death benefit to cover the spouse in the event that me, as the male, dies, let's just call it year one after signing this plan. She's going to be taken care of. Let's show you how this works. $31,000 higher gross pensions. That's $3,000 higher than the joint and survivor. Got to reduce it by taxes. Uncle Sam gets his cut. That gets us $20,000 of net. So that's a net increase of only $2,000. On the surface, this sale is dead, right? Because everyone that looks at these, or at least a vast majority of advisors, will come and say, hey, the cost of insurance is $3,000. I'm only net increasing my pension by $2,000. There's no way I can sell that. Well, let's look at it. So we're going to go same kind of thing, same death or life expectancy. We're going to take that additional pension. We're going to pay for, in this case, an index universal life policy, which has been hollowed out to give us the most efficient cost of insurance charges. Male dies at age 79 after 15 years. Life insurance benefit is paid out, tax-free, of course. And then we're going to take income to match this joint and survivor benefit over here. So you'll see that these numbers actually add up to the same as the after-tax version over here. And we're left at the end of this plan with $460,000 of economic benefit. Here's the point of all this, because it gets pretty math heavy quick. What we did, and what is maybe not intuitive until you go through the math, is we showed they're actually pretty close. No matter what you choose, client, you're going to be okay. How important, or what is your risk tolerance on this joint and survivor? For this guy, he's worth $3 million. He's got other assets. So this is important to him. It's important from a peace of mind perspective. But what was really important to him was the flexibility. He didn't want to give up this larger annual pension in the event that his wife dies before him. She's in poorer health, and granted, we modeled her life expectancy out quite a bit here. He doesn't want to give up the flexibility. So for example, here, if we have the insured pension, wife dies year 2, we cut the insurance contract. Insurance, life insurance anyways, is no obligation. You can cancel it at any time. That reduces his cost of insurance to 0. And he can go on collecting his additional pension instead of having it reduced. Moreover, he's got kids. So something happens, maybe they get divorced. If you read between the lines on my first comment about the lump sum, there's some marital issues. We could do this. We can change the beneficiary of the plan. We could make it a charity. We can make it the kids. What we've introduced here is a fairly complex planning strategy that's going to introduce flexibility into our plan here, which, as an advisor, to piggyback off what Tom was talking about, the only thing you know is that you don't know what's going to happen in the future. So that's something that we can create for you guys. Doesn't come up as much as it used to, but when it does, this is nothing to sneeze at, and some good value add for your clients there. So that
You know, one
Lisa,
of the things
go
that
ahead.
I've seen historically, Matt, is a larger disparity though between taking the lump sum and the spouse, because the spouse can take a full benefit too and bring that benefit down even more, or the spouse can take half the benefit and bring the benefit or the initial benefit down a little bit. So they give you several different options that you can choose. And sometimes the spouse goes, hey, I'm going to need more than that if you kick the bucket before I do. And so you have to really have that conversation. But I think using life insurance is a great vehicle if he does pass away first, and be able to have that lump sum to be able to supplement the income. So great job.
Yeah, and absolutely. And to Tom's point, the best place to start with something like this is getting us a copy of that pension details, because some of these, this one only had 3 options. Some of them have 4, 5, and 6, where you can really monkey with the levels there. And that's the level of expertise that we can bring you here at CPS. Get in there, let's do the math and take the guesswork out of it, and really makes it a pretty easy conversation once you know get past my math heavy Excel files here. With that, Lisa, do we have any questions that came in?
We don't have any questions at the moment, but folks, if you have any questions, now is the time to ask them. While you're doing that though, I just want to let you know that we are celebrating the opening of our new office in Irvine. So next month, on September 5th, we are going to have an open house party. I put the information into the chat. We're going to have the In-N-Out truck come and cater the event. If you're in the area, we'd love to have you stop by. There's no obligation. There's no registration. You don't have to pay for the In-N-Out truck. It's all on us. Just come out, meet the folks at the office, and enjoy some burgers on us.
Yeah, it'll be fun.
All right. Sounds great.
I think we're good, gentlemen.
All
Yeah.
right. Well, until next time, thank you for all your business, everybody, and look forward to seeing you next time on our CPS Live.
Thanks,
Thanks,
everyone.
everybody.